Welcome back to the channel, everyone. Today, we're diving into a fascinating topic that sits at the intersection of investment strategy and personal finance. Index funds versus actively managed mutual funds. Both options have their unique advantages and challenges, and as a financial expert, I believe it's crucial for you to analyze and reflect on which path may be more suitable for your individual financial goals. So let's get started. First, let's talk about liquidity. Liquidity refers to how easily an asset can be converted into cash without affecting its market price. When it comes to index funds, they typically allow for easy buying and selling throughout the trading day at market prices. This is particularly beneficial if you need quick access to your funds. On the other hand, actively managed mutual funds often trade less frequently, which may lead to delayed transactions. You might find yourself in a situation where your money is tied up longer than anticipated, especially if the fund has restrictions on when you can sell. Next up is accessibility. Index funds are generally easier to access for the average investor. With low investment minimums and a plethora of options available through various brokerages, anyone can start investing in index funds with relatively little capital. In contrast, actively managed mutual funds often come with higher minimum investment requirements and may involve navigating through a more complex selection process. However, it's worth noting that many actively managed funds have made strides in becoming more accessible over recent years. Yet, the perception of complexity still exists. Now let's delve into profitability. This is where things become particularly interesting. Index funds tend to have lower fees compared to their actively managed counterparts because they are designed to track a market index rather than employ a team of analysts to select stocks. Lower expenses can translate into higher returns over time, particularly in efficient markets where it's tough for active managers to consistently outperform their benchmarks. That said, there are certainly actively managed funds that have demonstrated substantial returns over extended periods, though this is not the norm for all actively managed options. The next factor we should consider is risk. It's essential to understand that while both investment vehicles come with their own set of risks, they manage them differently. Index funds expose you directly to market fluctuations since they aim to replicate the performance of an entire index. This means when the market dips, so does your investment, an inherent characteristic of passive investing. Conversely, actively managed mutual funds can mitigate some risk through strategic stock selection and diversification. However, this also comes with its own pitfalls, as not all managers successfully navigate market volatility. Psychological factors play a crucial role in how investors interact with these two types of funds as well. The allure of active management often lies in the belief that skilled managers can outperform the market and provide superior returns. This psychological bias can lead some investors to overlook evidence suggesting that many active managers fail to do so consistently over time. On the other hand, investing in index funds may offer peace of mind due to their straightforward nature and historical performance trends. However, some investors may struggle with the concept of buy and hold during turbulent market conditions. Now that we've explored liquidity, accessibility, profitability, risk, and psychological factors related to both index funds and actively managed mutual funds, it's important to remember that there isn't a one-size-fits-all answer here. Each investor's circumstances are unique, shaped by personal goals, risk tolerance, investment horizon, and even emotional readiness for market fluctuations. In conclusion, I invite you to reflect deeply on your own financial journey as you consider these two investment options. Are you drawn towards the simplicity and lower costs of index funds? Or do you find yourself intrigued by the potential of actively managed mutual funds despite their higher fees? Whatever direction you lean toward, make sure it aligns with your long-term goals and values. I encourage you all to share your thoughts in the comments below. What has been your experience with either option? Do you prefer one over the other? Let's engage in a thoughtful discussion about investing strategies that can benefit us all. Thank you for tuning in today. Don't forget to like this video if you found it helpful and subscribe for more financial insights. Until next time.